Hi, I'm Christine Giordano. I'm editor-in-chief at Markets Group, and I'm here with TJ Carlson. He's the Chief Investment Officer of the Missouri State Employees Retirement System. That's a $9.5 billion system in capital, and it's got $12 billion in exposure as a levered portfolio. TJ is about to win a strategy award at our annual retreat for Markets Group. Now, he's done some interesting strategies with Portable Alpha. In two separate occasions, this Portable Alpha portfolio has delivered between 250 and 300 basis points. We'll get into that, as well as his illustrious, multifaceted career. TJ has been at Texas Muni. He's been at Kentucky. He's been a partner at Ennis Knupp, CIO of Marshville Clinic, CIO of West Virginia Investment Management, and in the Marines for 6 years. Welcome, TJ.
Thanks, Christine. Good to be here.
It's great to have you. So let's start from the top. Having been a Marine, how do you apply that to your approach and your investment management style?
Well, I think that, having a military background gives you certain skill sets and implementation styles that can work well across lots of different environments. I would probably say the first one starts with understanding a chain of command. And along with that chain of command comes a willingness to delegate and hold people accountable for that. And so that has served me well over time. People on my team enjoy when they get delegation, they get to help make decisions. And so that's been a key component to what I feel like some of my successes are over time that came from the Marines. One of the other things that I learned as I was coming up through the Marines and then becoming a leader there, which was don't ask others to do things that you haven't done or that you're not willing to do today if you need to. And so making sure that you're just as invested in the outcome. And if you need to pitch in and do an operational due diligence report because somebody had a family emergency and you still have a deadline, you've got to be willing to step up and do that and not use it as an excuse to not hit your goal. Going along with that, I would say leading by example. And so again, that's whether it's attendance or attention, your willingness to listen to different ideas and pitching in wherever you need to make sure that the program is a success and that everybody on the team is a success, not just the CIO or the deputy CIO or whoever that's going to come down to. I would say one of the other things, because if you've ever been in the military, it's a hurry up and wait. And so being patient and being persistent are a couple of other keys to being successful in leadership, either in the military or at a pension fund. Because everyone knows pension funds don't change overnight. So you have to be patient. You have to be persistent and have a long-term vision. Don't get frustrated when you don't get what you were trying to accomplish on the first go round. Go back and find another way to explain the situation or get more support so you keep working on it. I guess one of the last things I would say is practice extreme ownership. I stole that title from a book by Jocko Willink, who's a famous corporate speaker now and a former military person as well. And that in doing that, you have to understand and accept that everything that happens in your chain of command below you is ultimately your responsibility. And so because if somebody under you fails to meet the goals that you laid out for them, it could be number one, that they didn't pay enough attention or didn't listen when we were talking about it, or it was that you didn't train them to do that activity well enough and you should have trained them more. This book by Jocko, I actually bought that book for all of my staff, both here at MOSERS and when I was at Texas. So I gave a copy to anybody who wanted it. It's a good book.
Did being a Marine kind of help you understand the the workings of American government, of American industry, how these things work together, and give you a greater understanding as an investor?
I would say that being in the Marines and working at all of the different types of systems that I worked at, it gave me a bigger, broader appreciation for geopolitics and other people's perspectives, and to always remember that it's important to understand from somebody else's point of view, how are they viewing it? And so I would say that that was a very important thing as I was learning to work with individuals from different states or different countries. When I was in Desert Storm, we were part of a multinational force and had to interact with many other militaries from other countries from all over the world. And so being able to communicate and get on the same page with those people is very important.
How do you apply that from your different roles in Texas, Kentucky, West Virginia, and a snub, and as CIO of Marshfield Clinic?
Once you've been through the industry for as long as I have, we all become accumulation of the different experiences that we have over time. And I've been very fortunate to have a lot of varied experiences in my career. And so I feel like I've learned different things from each position that I apply all the time in many different situations. I would say that starting out with the public pension space, even at Iowa, West Virginia, and Kentucky, those were all three materially different governance structures. West Virginia is an investment board, Iowa is a lay board, Kentucky is a elected more political board. And so I took lessons from all of those different places and try to apply them wherever I'm at now. Working at Marshfield Clinic, I was in charge of the reserve assets for an insurance company. We were self-insured for medical malpractice. We had an endowment. I led a tax-exempt debt issuance. I ran some DC plans there. So again, good experiences that help you think about things from different points of view as you're doing that. And then, with Texas, I had a much bigger pool of capital. It was almost 40 billion by the time I left there. And so, understanding capital pool size and its impact on the opportunity set that you can take advantage of, or frankly, the opportunity set you can't take advantage of, because sometimes the opportunities are too small for you to efficiently and effectively take advantage of them when you're a bigger pool. And then I would say finally, when I was at Ennis Knupp, I was very fortunate to work with the US government some. I worked with universities, hospital systems, 2 different state treasurers' offices. And so I got a lot of good, varied experience as well there, and how to think about things from another person's point of view and what might be most important to them so that you can communicate with them effectively.
Can you talk about MOSERS? It has an ex-China mandate now, and how you've kind of been leaning into your North American investment.
So I guess there's 2 material points there. In December of 2023, the MOSERS board did an evaluation of the global public equity space and were somewhat concerned with the different layers of financial risks, less reporting, consistency out of some of the Chinese markets, and then the different geopolitical risks that you hear about every day in the nightly news now. And so they made the decision to move our global public equity portfolio to an ex-China posture. And so since that time, we've been transitioning that portfolio and had to do some analysis about what did we believe the best way to implement that portfolio was. At the time, we were doing portable alpha in the US over the US benchmarks. However, we were doing active management in the non-US space for both developed and emerging markets. And when we did this analysis, the ex-China universe of managers with material experience here, we found it to be, it is an up and coming practice for many different managers. but we were not comfortable being able to build an entire actively managed portfolio that we felt would give us decent levels of alpha plus consistent returns, consistent alpha. And so we have such a long experience with portable alpha that we felt that that was a better opportunity for us. So we transitioned at the same time that we transitioned to an ex-China posture. By changing our underlying derivative that we have exposure to, we also moved away from the active management sleeve there, and we now do all of that through derivatives plus portable alpha.
So you've also increased your private credit. In what areas have you done that?
Private credit is a vast and wide opportunity set. So you can do this many different ways. 5 years ago, we had very little in private credit. Then our board passed a new asset allocation that had a 5% allocation to private credit. And, we started where many pension funds start, with the upper middle market, sponsor backed, direct lending kinds of strategies. And then over time, we built out and added to some non-sponsored and lower middle market types of strategies. And then by the time we were getting close to our 5%, our board actually liked that portfolio quite a bit. The opportunity set kept growing. And so they moved the allocation up to 10% now. So now we're in the process of going from 5 to 10. And so we're looking at other ways to diversify that asset class. And we are adding now to some asset-backed deals. And then we're also looking at opportunistic credit. And then finally, we're evaluating whether or not we can come up with some unique account structures through separately managed accounts or some other method where we can do some multi-asset class implementation in that private credit space. So we're looking at some of that.
In your private credit portfolio, can you describe what you're seeking within your complexity premium?
One of the opportunities that we like to look at, we don't always take advantage of, is the fact that some allocators don't want to either take the risk of more complex deals, or they don't have the time to spend to evaluate these deals. And we tend to like to look at complex deals. We think that there can be a complexity premium once you've learned how to look at this space, evaluate it, and you hire the right managers to work with. And so we look for good firms in these spaces who have a history of embracing complexity. They have the teams that are built out not only to do the deals when we're looking at them, but also they already have in place the team that you need to help work it out if it doesn't go as expected. Because with complexity comes more work. And so you have to be ready for that. You have to be prepared for that. Kind of going back to the Marine Corps thing, you got to be prepared for whatever comes your way, making sure that you're making good decisions, rational decisions, and you're ready for all the potential outcomes of that is important when you're doing more complex issues.
Everybody loves a good comeback kid story or a, success story, especially within this economy. Do you have any case examples that you might refer to on a high level?
One of the best examples that I would have is that we had an exposure and the company was going through a troubling time for their sector in the economy. The manager was still highly supportive of this company. And in the end, there were many people who were trying to find a buyer for their exposures because they just wanted out and they were willing to take 15, 20 cents on the dollar. And so we worked with that manager in a lot of detail over a very short period of time. We felt we were confident that once we got past about 3 to 6 months, that this was going to be money good. And while it might not go from 20 to par, it was highly likely to go from 20 to 75, which is a great return. And so we actually bought up several of those exiting investors' positions and added them to our account, and it worked out really well.
You've also increased your private real assets. Any key takeaways there, and in what areas?
6 years ago, we had two different allocations to real assets. We had real estate and then we had non-real estate real assets, but it was all in public real estate. So it was basically an indexed REIT portfolio. And in the last allocation last year, we changed that from a REIT allocation to a private non-real estate real assets. And so we're looking at things there. We've added an agricultural fund. We've added some metals and mining. We're looking at some infrastructure stuff. We're looking at both primaries and secondaries. That seems to be a pretty attractive place right now. We're continuing to build that out. And, longer term, my goal would be to do like we did with private credit. And hopefully once we get close to the 5% mark, the board will like the portfolio that we've built and they'll let us move that to 10% because I think that would be a good opportunity for us longer term.
We've been at MOSERS for like 3 years.
Yep, almost 4.
And you've been hitting your benchmarks every year, and now you're introducing this portable alpha strategy correction. You've already introduced it, but you want to kind of expand it now because it's been so successful with the 250 to 300 consistent basis points in return on alpha. And so you've applied that differently, different time periods. If you could kind of give us a history and give us the game plan ahead for what you're about to do.
MOSERS has a long history with portable alpha. I would describe it that we've implemented it on 2 different occasions when it was best fit for the portfolio. So we did it back in the 2000s, which was before I was here. It was implemented and got very consistent returns in the 200 to 300 basis points over time, net of fees. And at that point, it was primarily over the equity piece. And then when MOSERS went to our risk parity strategy in roughly 2012, that was no longer a good fit for the portfolio. And so it was phased out at that point as we ramped up the risk parity piece. And then in around 2018, at that next asset allocation evaluation, the board decided to modify the risk parity into a risk aware strategy and to bring back the portable alpha strategy. And so we started rebuilding that now. So we've been doing that since 2018 or so. And again, it's been a very consistent performer for us on a net of fee basis.
And the classes that you use it in again are?
So we actually use it in all of our asset classes right now. We use it in public equities. So all of our global equities are implemented through derivatives, basically swaps. And then we put portable alpha on top of it. We're using it over our treasury portfolio. We use it in private equity as a private equity surrogate. So we use the ACWI ex-China swaps, and then we put portable on top of that. And that basically is our funding asset. So at least we're matching our risk and return from the expected private equity benchmark over time. So we don't have any drag there. We're also using it on our new real asset benchmark. So we can get swaps on our real asset benchmark and then put the portable alpha on that as we're waiting for our new real asset managers to call capital. We're using it in private credit where we use a couple of different underlying betas such as an iBox or BKLN ETFs and CDX swaps, and then put portable alpha on top of that as we're building out that private credit portfolio. So again, it becomes the funding asset for all of our asset classes.
When you made your choices on picking good beta to overlay it, how did you kind of determine that?
Well, it's kind of a triangulation, I would say. You have to look at what is your actual benchmark and what are the derivative options to implement that. Can you do swaps? Can you do futures? Do you have good relationships so that you can get access to those when you need them and need to change it? You can analyze different regressions to find out which ones work better over time. And so, what we found is like on private credit, we have three opportunities for us to use the beta, because what we found was that depending upon what time frame you were trying to set this up for, some of the betas actually match the benchmark every day pretty well, but they vary a little bit more over time. Other ones vary more over the short term, but they're very consistent long term. And so if we have short term money, we may pick one beta. And if we have longer term money for private credit, we may choose a different beta that will have a little higher tracking error for us in the short term, but will provide good results for us longer term.
And how much do you hold in cash?
We have about $2.5 billion in cash right now, and we manage that internally so that we have good control over the transparency, the structure, the maturity. It's a pretty liquid pool. So about 85% is in U.S. government guaranteed, almost 100%, probably 95% is overnight. With a little bit of term structure in there, but it's very liquid, very high quality cash.
What do you do with the cash collateral?
As we invest it, we have to then make the decision about how much collateral to actually invest in the Portable Alpha program, and we keep the rest of it in the cash program. And so we do that based upon it's a risk-based philosophy, and so we want to hold enough cash on whatever instrument that we're putting the Portable Alpha over that we can handle a 3 standard deviation move in a very short period of time. When you think about that, if you say U.S. Treasuries, where we do put some of this on, standard deviation there is, call it 8% over time. And so we would hold roughly 25% cash back for that portfolio. And then we would be able to invest the balance in the Portable Alpha program to get that excess return. But that's different than if we're doing it over an equity program that maybe has a 17 volatility. So we would hold 50% cash there and only invest 50% in the Portable Alpha program over time.
Is there a golden kind of ratio that, if you're going to take this much risk and volatility, you need to hold this much in cash?
No, I would say there's not a specific golden rule. It's whatever you're comfortable doing. So we've made the decision to hold on equity side, we hold 50%, but there's many off the shelf kind of Portable Alpha programs that are out there, and they would run anywhere from 25, 30, 35% cash across the total program. And so they're comfortable in having less cash, and we just want to make sure we have more cash.
Over time, you've been overperforming your benchmarks by 80 to 150 basis points, net of fees. How do you do it?
Well, a big chunk of it is the Portable Alpha programs there. It's hard to find the right hedge fund managers to run our Portable Alpha program. So we run that market neutral, factor neutral, net return focused, and so finding those managers that consistently can add, say, 400 to 500 basis points over cash. And then if we're holding 50% cash behind it, so we're only earning returns on 50%, that would be, if you make 500 over cash divided by 2 is 250 basis points. And so trying to find those managers that do that consistently is a pretty big challenge. So access to those managers is critical for us. And then for the rest of the portfolio, because that's only a piece of the portfolio, the rest of the portfolio, I think focusing on every strategy and having a target focus on what kind of excess return is reasonably possible, what's the best way to implement the strategy to take advantage of that and capture that, and how much cushion can you have, because you're not going to get every decision right. So how do you make sure you have a little bit of cushion to make sure that happens? And so, like you said, our historical performance goes anywhere from 80 to 150 basis points annualized over a year above our benchmark.
You were able to get board discretion while you were in Texas as the CIO of Texas Muni. It's something that some CIOs envy, and still kind of fight for. What was key to getting that, and what is some good advice that you might offer?
Some of the keys to what we did at Texas goes back to what we started the conversation with is patience and persistence. Keep educating people, keep talking with people, keep answering their questions. One of the other things that I think was key for us in Texas, I'm a big believer in process. And so we talked with the board at one point about setting up an investment committee of the board. And the board at that point decided that they liked managing by the board as a whole, which is 100% their prerogative. And I'm glad that they did that because it actually worked out really well. But what I decided to do then was that in analyzing and that making that recommendation that was ultimately turned down by the board, I said, you know what, we need to start a staff investment committee here, and we'll run our staff investment committee just like a board investment committee. So we set up a charter, we took minutes, we had certain people that had voting authority. We had override issues. And so we ran this and we communicated with the board we were going to do this and that we would give them access to all this information. We did that for about 2 years. They took comfort in the fact that this was a very structured, well thought out, well laid out program. And they took comfort that those decisions were being made appropriately. And then what we ended up doing was setting up some guide rails and said, okay, staff has discretion within these bounds. For example, private equity was staff had the discretion to invest up to 1% of the fund's value in a fund and then would report it after the fact to the board so that they're aware of what was done. If we wanted to allocate more than that, we would have to take it to the board to get their approval, which I think we did in my time there. I think we did that twice because the opportunity set was so good and we wanted to upsize certain managers. And so we were flexible and said, nope, that's reasonable. We'll bring the bigger ones to you and the smaller ones, the staff will do. And it worked out really well.
You're also known for being very active in industry groups. You're kind of the glue sometimes that holds people together as far as the CIO community. What are you seeing in regards to CIO concerns and trends regarding this economy?
The increasing complexity of the opportunity set is a challenge for everybody these days with the lack of distributions on private equity. But it's not just the lack of distributions, it's also the opportunities that the GPs are taking to extend their funds, whether they're continuation vehicles, whether they're providing access to different co-investments to different groups of people. It's just becoming harder and harder every day to make sure that you're getting to see the appropriate opportunities, that you're not being forced into less optimal situations where it might be a continuation vehicle that they should just really sell it and return the money, because in the end it may be a 3 or 4 year further investment and the value over that 3 or 4 years is not going to be as good as a different opportunity that you might have had you got your cash back and been able to invest it in a different opportunity. So I think that's an issue. I think access is an issue. It's a dual-edged sword right now. Some people are slowing down their allocations to private equity, which you would think would give you more opportunity, but then some managers are either keeping the size of their fund the same or pulling it back a little bit. And so the opportunity doesn't seem as robust as it has over time. And so navigating these additional complexities, also having to deal with, NAV loans where some managers are doing NAV loans to get their investors liquidity. These are all newer types of complexities that we're having to evaluate and deal with. I think then governance would be the last one, because that's always an issue for many funds, whether you're an endowment an insurance, a public pension plan, making sure the right governance is in place, and almost more importantly is making sure that that governance can survive for the long term. Because one of the worst things that can happen to a fund like us is you get changes in governance or too much turnover at the board level, and you can get whipsawed into many different things. And so having good governance and making that good governance live for a long time is very important.
You're also known for your team building. Can you kind of talk about that philosophy? How do you create that wonder team?
Building the team is my hardest and most important job. I spend a lot of time on it. You need to make sure that you're all pulling in the same direction and that you have people that understand the goals and practices at the firm. And so it actually takes a long time to build that team. I had one time at a fund, and I got called into my boss's office, and we were trying to hire a senior person, and my boss was asking me, why was it taking so long to fill this job? Because they knew we had 500 resumes that came across my desk, and I should have been able to hire somebody by then. And I said, the reality is I have had 500 resumes, but I haven't found the right person to run this program. This was going to be a new program. We needed a very specific set of skills for this first leader that was going to be leading a material portion of our portfolio going forward. And so it took a little longer, but in the end, I think that that's very well worth it. I'd rather spend more time. And they actually pushed back on me a little bit and said, well, but it never took us this long before to hire somebody. And I said, you mean this person and that person and that person that they either left or we had to let go because they didn't work out very well? It's critical for what you do as a CIO, but it's also not just skill. Sometimes you just get lucky and you find the right person at the right time who wants to come and work with you, whether it's an up-and-comer who's going to work 22 hours a day and they have an incredible investment mind, and you find that person and you give them good opportunity and they move up quickly, or whether it's a more senior person who doesn't want to deal with whatever the struggles are at the place that they are now, and they want to go back and just handle one or two asset classes and get back to investing and not have to deal with, whether it's politics or governance or some of the other issues that we all have to deal with over time. So a lot of work and a little luck.
You mentioned geopolitics, that you kind of are sensitive to that, have a deeper understanding of that. What are your favorite sources and what are you focusing on currently? What are you watching?
I tell people I'm watching everything all the time. It's important to make sure that you step out of your biases and look at it from somebody else's point of view. Don't just look at the Wall Street Journal, look at the FT or look at some other credible news sources from other places, because it's amazing how something that you thought was very simple is not so simple when you look at it from somebody else through somebody else's eyes. And so I think it helps give you good perspective to make sure that you're purposefully trying to incorporate other views. Having a good diversified investment team helps with that as well, whether that's being from different countries around the world, being from different areas in the United States, so that you get good consideration of multiple points of view.
Anything concerning you right now that you've got your eye on?
As many people are right now, the volatility in the geopolitics is troubling is probably not the right word, but it's something you got to watch and you have to be comfortable with. But in the end, I have to build a portfolio that's going to be successful over the next 10 years. Even with something that's happening right now that could be very impactful over the next 2 months, is it really going to be that impactful over the next 10 years? Or do the other portfolio attributes that we build into our portfolios with diversification and equities and debt and public markets and private markets and cash, as we're balancing all of these things, I take a lot of comfort in the fact that my portfolio might take a short-term hit, whether it's the GFC, the rate tantrums in the 2013, 2014, or the first Trump election, or, whatever's going on any day, we build a portfolio that is intended to go through whatever the markets throw at us. And so I keep that in the back of my mind.
You're also in this area of America that's almost like a litmus. Being in Missouri, MOSERS is the nickname for your fund. And so do you ever kind of watch public sentiment around things and kind of involve that into your thought processes?
We certainly watch it, but we don't do a lot of portfolio changing based upon that. Again, we take a longer term view, and those sentiments can change overnight. So if you think about one political administration, the administration we had 3 years ago, you had an entirely different sentiment that you had today. But I have to have a portfolio that does well in both of those. And so while you want to be aware of it and you want to make sure that there's nothing that's going to implode your program, you can't move your portfolio based on short-term sentiment.
And in the spirit of community, if people want to pick up the phone, other allocators, and kind of ask your advice or chat with you about something, what are some of your favorite topics to talk with other allocators about?
Interesting account structures are always, I'm always interested in learning about how people are building a better mousetrap, whether that's fee alignment between LPs and GPs, or structures that create better alpha opportunities with complexity sizes and commitments with managers. Strategic partnerships are always interesting. Some people think strategic partnership means we buy more of your stuff, but to us, that's not what we think a strategic partnership is. We think a partnership means that you both end up in a better spot because you created a better deal. And so people have ways to think about those things. Governance solutions is always a fun topic to talk about. I guess those are the big ones.
Fantastic. Thank you. And very much looking forward to seeing you in Utah at the retreat.
Yes, we'll see you in Utah.